Well, the high interest rate environment that has become the bane of existence for Kenyan traders and individuals could begin easing in the coming weeks as banks begin adjusting to new realities on the ground. According to the central bank, the current high lending rates by banks was a reflection of the high treasury bill and interbank rates witnessed in the last 1 month, owing to tight liquidity in Kenya's money market brought about by CBK's frequent mop-up operations that sought to tame the weakening of the Kenyan shilling. The situation was also worsened by the perception that Kenyan government had insatiable appetite for debt and was desperate for funds. As a result, treasury bill rates, the rate at which government borrows short-term debt from the local market, hit 23%. But with the $600 million syndicated loan and tighter fiscal controls, CBK says the worst has passed, with the T-bill rate cooling back down to 13.7%. As such, banks which take up more than 52% of state borrowing will be left with idle funds on their hands. And according to CBK, this will be a boon as banks which have raised their lending rates to a high of 27% will also have to start revising downwards their rates to accommodate the new reality.
And they will see that the interest rates are coming down or have come down in the government securities market, and therefore they understand the dynamics, and therefore they too will need to look at their own commercial lending rates. So we believe that these interest rates will come down also quite soon. So we're not talking months, we are talking weeks even, because the two can go quite quickly. It's not like we have in England. So in that sense, I think we are waiting for the commercial banks. We've already talked to them, and they will in effect be moving to indicate lower commercial lending rates to their borrowers.